Imagine turning every $10,000 into $22,500 in under 12 months. That is not a crypto promise or a get-rich-quick scheme. That is exactly what happened to investors who bought the Global X Lithium and Battery Tech ETF, ticker LIT, at its low point last year, 125%. That is the return LIT delivered from trough to peak for those with the conviction to buy when everyone else was selling. The stock market was rattled. The Federal Reserve was hiking rates. Sentiment on clean energy was ice cold, and yet, buried inside that fear was one of the most asymmetric opportunities in years. Today, we are going to break down exactly how it happened, why lithium demand is not going away, and what investors should understand before making any move in this space. In this video, you'll discover what drove LIT's explosive recovery, how the Federal Reserve's interest rate policy created the conditions for this opportunity, why lithium is structurally critical to the global economy, what the top holdings inside this ETF actually are, and what risk factors every investor must weigh before buying into any commodity-linked fund. Stay with us through the end, because the disclaimer and the risk section are just as important as the upside story. Let's start with the setup. The Global X Lithium and Battery Tech ETF, ticker LIT, tracks an index of companies involved in the full lithium cycle. That means lithium miners, lithium refiners, and battery technology manufacturers. Think names like Albemarle, SQM, Panasonic, and BYD. This is not a single stock bet. It is a diversified basket across the entire lithium value chain, which is why it qualifies as a legitimate ETF investment rather than a speculative punt on one company. At its low, LIT was trading deep in the red after a brutal 2023 drawdown. Lithium carbonate spot prices had collapsed, falling more than 60% from their 2022 highs. Investors in the S&P 500 were already nervous. The Federal Reserve had raised the federal funds rate to its highest level in 22 years, sitting at 5.25%. High rates make growth assets expensive to value, and speculative sectors, including clean energy and battery materials, took some of the hardest hits. That environment of maximum pessimism? That was exactly the moment LIT bottomed. Now, here is why the recovery was so powerful. Lithium is not a discretionary commodity. It is an industrial necessity. Every electric vehicle on the road contains a lithium-ion battery. Every grid-scale energy storage system depends on lithium chemistry. Global EV sales crossed 17 million units in 2023 and are projected to reach 40 million units annually by 2030, according to Bloomberg NEF. That demand curve does not reverse. When the market finally began to price in the structural reality that lithium supply is constrained while demand compounds, LIT began to move fast. The catalyst that truly ignited the rally came from two directions simultaneously. First, the Federal Reserve began signaling a pivot. Markets started pricing in rate cuts, which lifted the valuation ceiling on growth and commodities. When the cost of capital falls, future earnings become worth more today. That single macro shift re-rated dozens of assets across the stock market. Second, several major governments, including the United States under the Inflation Reduction Act, accelerated subsidies and tax credits for domestic battery production and EV adoption. Policy tailwinds met suppressed valuations. The result was a 125% gain for investors who had positioned at the low. That is not luck, that is the compounding effect of macro timing meeting structural demand. Let's talk about what is actually inside this ETF, because the composition matters. LIT holds approximately 30 to 40 companies, with its top 10 positions typically representing over 50% of the fund's weight. Albemarle Corporation, one of the world's largest lithium producers, has historically been a top holding. SQM, the Chilean lithium giant, is another core position. On the battery technology side, you have exposure to companies like Samsung SDI, CATL, and Panasonic. The expense ratio sits at around 0.75% annually, which is standard for a thematic ETF in this category. This is an actively rebalanced, rules-based index fund, not an actively managed portfolio, so the strategy is systematic and transparent. Transparency matters when you are trusting a fund with your capital. Now we have to talk about risk, and we are going to give this section the weight it deserves. Thematic ETFs are high-conviction instruments. They concentrate exposure in a single sector or theme, which means volatility can be severe in both directions. LIT proved that on the downside when it lost more than 60% from peak to trough during the lithium correction. Commodity prices are notoriously cyclical and difficult to predict. Lithium carbonate prices can swing dramatically based on Chinese production volumes, new mining discoveries, or demand misses in EV sales. If interest rates stay elevated longer than expected, or if the Federal Reserve reverses course and hikes again, growth-adjacent assets like LIT could face renewed pressure. The S&P 500 itself is not immune to that scenario. Always think about correlation and position sizing. Never allocate more to a thematic ETF than you can afford to see cut in half, because historically it has happened before and could happen again. This video is for educational purposes only and is not financial advice. Always consult a licensed financial advisor before investing. The LIT story is a masterclass in what happens when structural demand meets cyclical fear. The Federal Reserve created the conditions. The lithium correction created the price. And investors who understood the difference between a broken thesis and a temporarily broken price, they captured 125%. Knowing how to read those moments is one of the most valuable skills you can build as an investor. If this video helped you think about ETFs and commodity cycles differently, hit that like button right now. It genuinely helps this channel reach more people who want straightforward financial education. Subscribe to YieldWire so you never miss a data-driven breakdown. And check the description below. We have linked resources and tools that can help you research ETFs, track interest rate decisions from the Federal Reserve, and monitor S&P 500 sector rotations in real time. The link is down there. Use it. Your next opportunity is already forming somewhere in this market.